Valerie Kepner is a professor of economics and the director of the Center for Excellence in Learning and Teaching at King's College. Valerie, thank you so much for taking the time today.
You're welcome. Thank you for inviting me.
So to start, I've been asking this question and I'd love to hear your perspective. How much money should exist?
I, when I first am hearing this question, I'm thinking there's really not a number that I know of that economists are going to point to and say, if we've got this much production of gross domestic product, all of the value of the final goods and services in an economy, there's a perfect dollar amount of money that should be out in the economy. That's not typically what we talk about, but what we do want is to make sure that there's enough money circulating in the economy to facilitate transactions that people want to happen. And then we've got monetary policy, which is not actually the printing of money, but it is the buying and selling of treasury bills, which then affects the quantity of basically checkable deposits or checking accounts, and that affects the amount of money in the economy. But that changes according to whether or not the Fed thinks there's inflation that needs to be gotten under control, or if we want lower interest rates to grow the economy. And so I would say you don't want too much money because that leads to runaway and hyperinflation, which we absolutely don't want. But we don't want too little money either because that stifles transactions. And so somewhere between there, and there are different measures of money. So if we're talking M1 versus M2, I don't have a specific number though for how much money there should be in an economy.
So when talking about the kind of the too little scenario where you don't have enough circulating to facilitate transactions, how do we know when we need to inject more money into the economy or when the Fed needs to um, enact the policies that you were describing?
For the first question, I would say that there are economists within the Federal Reserve banks across the country and the National Federal Reserve that would be keeping track of whether or not too little money is circulating. But in terms of the Fed's monetary policy, they are specifically looking at unemployment numbers, inflation rate numbers. They are tasked with keeping inflation rates low and stable, and also keeping unemployment rates fairly low. And so, but sometimes if you want to keep inflation low, that means unemployment is going to go up and vice versa. And so the Federal Reserve is tasked with trying to balance those two.
Yeah. Well, so the next question I have is related to how we inject money into the economy. What is the best way to inject money into the economy, and how do you think about that?
I would say the way that I know how the US injects money, I'm going to put quotes around that, into the economy is through the Federal Reserve. And it seems to be working. It's worked quite well, though. Reading a book right now talking about the Great Depression and the Federal Reserve's policies at that time probably did us no favors during the Great Depression, but economists disagree on that. Uh, but having the Federal Reserve with the economists who are gathering the relevant statistics and the data, if they decide that they want the economy to grow, then what they do is they lower interest rates, but they don't do that by command. They don't tell the economy and the banks and anyone else who charges an interest rate, now you're not allowed to charge an interest rate over 3%. Instead, they go to the Treasury securities, Treasury bills market, and they buy or sell. And in this case, if they were looking to inject money or lower interest rates and cause the economy to grow, what they would do is they would buy treasury bills. And so banks own the treasury bills, and the Fed says, here, we're going to pay you for them. So now the Fed owns the treasury bills, but the banks got money that they didn't have before. And now they can turn around and loan that money out, and it becomes part of the economy. Does that make sense?
Yeah, yeah, it does. And is just doing that that leads me to my next question, which is it possible to inject money and particularly in the way that you just described, inject money into the economy without causing inflation?
In the long term, probably not. In the short term, if we don't have enough lending going on, like during the Great Recession, lending just froze up. And it wasn't so much just lowering the interest rate that caused the economy to grow again. It was the federal government getting involved and shoring up some of these financial institutions that got lending going again. But uh, when you lower interest rates, then banks are going to, hopefully, you can't push on a string, right? You can't make banks loan out money, but investment opportunities for business owners are cheaper for them to invest in. And so there should be greater demand to borrow funds to expand businesses, for households to go out and refurnish their home or redo their kitchen, or the big ticket items, go out and buy a new car. And that lending now happens, and that gets the economy going again. I think I maybe got a little off from your original question, but that's how the Federal Reserve sees the interest rate working. And so if I remember now, if the economy is not doing well, unemployment is high, there's a lot of resources that are just not being used, in theory, there should not be much, if any, inflation when the Fed engages in increasing money through lowering interest rates. If we were at full employment, everything's humming along, then you would expect more immediately that there would be inflation. Because if all you do is just increase the money supply, prices are going to have to go up to meet to because so many people have so much money. There's too much money with too few goods, and so prices have to go up, and that's the definition of inflation.
So the inflation that happens when you say the prices will go up, that's the aggregate price level, right? It's not saying
Yep.
that everything will go up evenly. It's like
Correct,
the
correct.
CPI or some aggregate measure,
Yep.
everything goes up on average by a proportional amount to the money supply increase. Is that accurate?
Yes, yes. So some prices might even go down, I suppose. But some prices might go up by a higher percentage than other prices. Yeah. So we use the consumer price index, or the GDP, the gross domestic product deflator, to measure percentage change in the aggregate price level. Yep.
Okay. So I want to switch gears a little bit and ask you about the national debt. How can the U.S. Pay off its national debt, and is increasing the money supply part of the solution?
Could the US pay off its debt? Yes, but it would be incredibly painful, because taxes are going to have to go up, and at the same time, government programs are going to have to be cut. And should money be printed to pay off a debt? Absolutely not. If you want runaway inflation, if you want the American people and really people, investors around the world to not trust the United States to be responsible with its debt, then go ahead and print money. I had a graduate professor in a macroeconomics class say there are two ways you could take care of debt. You just never want to use them, which is the US government has the legal right to print money and just pay off the debt that way. But it'll lead to terrible inflation because you're going to have too much money with too few goods for people to buy with that money. So again, prices have to go up. He said the other way to pay off the debt is just tell people, you know what, we're defaulting. We're not, you don't, you know, we're not going to pay it back. And both of those options are awful. I mean, they're just terrible, terrible options. But I'd say to some extent, I don't lose sleep. Truly, I do not lose sleep over the level of debt. It is the percentage of our production, our GDP that goes to paying the interest rate costs of carrying the debt. So the larger the debt, the greater the interest rate costs, assuming interest rates stay the same or go up. That's of concern. And otherwise, I also like to think of it too. If we were at war right now, no one would be talking about balancing a budget. So to some extent, I realize trillions of dollars of debt sounds terrible, but it's not, it's just not as big a concern to me as having, say, 25% unemployment and inflation of even 10%, right? A 10% inflation rate is going to wreak havoc. And so carrying this debt, uh, and as far as I know, there's no way for the holders of the US debt to make the US pay off the debt before the 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 maturity date. So as long as we can pay off, we can pay back those who hold treasury securities when we're supposed to, and then just put out new debt and people buy that new debt, then that's something special about, special may not be a positive word, but it's something special about the US federal government that's different from states, right? State governments can't print money. They don't typically get the trust of the people in the same way that the US Treasury bills and bonds and notes, people expect the US government will always pay its debts.
Yeah, so the just following up on that, the notion of so you described the percent of GDP that is going towards interest payments is really what we should be concerned about. Is that something that we can address through fiscal policy, and we don't necessarily need um, Federal Reserve intervention for that specific metric, or how do you think about that?
I think about that as both fiscal and monetary policy. I could see absolutely fiscal policy could play a role if you actually run a surplus. For example, you could, which I believe only last happened under President Clinton, um, but that surplus, that's actually going after the debt, right? If you run a surplus, you can take and but I hear politicians talk about, well, if we have a surplus, we can lower taxes. Well, why would you do that if you're concerned about the debt, right? If you can pay down some of the debt, that's going to lower the interest rate costs. Uh, but you could also, though you don't really want the Fed manipulating interest rates lower, just so the federal government has a lower interest rate cost. I think it better to lower interest rates to try and get unemployment rates to a very low level, keep inflation rates steady, and hopefully use even fiscal policy to invest in infrastructure that'll lead to growth, and you won't have to raise taxes to cover a higher interest rate cost.
So that seems like so I was telling you before we started recording that I've always thought of the four tools for addressing national debt is taxing, cutting spending, printing, or growing. And it sounds like the most or the least painful option is what you just described, where we invest in infrastructure that facilitates growth, and that growth allows us to get to surpluses or pay down the national debt more without um, lowering taxes, without cutting spending significantly. Is that a good way of thinking about that? Is that accurate? What do you think about that?
I think that's totally accurate. The least painful way is going to be through growth, paying down the debt, uh, because printing money is going to be probably the most painful across a wide range of people. Cutting spending is going to be painful too. And then you would actually have to raise taxes to pay down the debt. I know there's talk about, well, if you cut taxes, people work harder, there'll be more investment in the economy, and tax revenues are going to go up. In reality, that's trickle down economics. And in reality, I've never seen, economists disagree about this, but I've never seen definitive evidence to say that Reagan's trickle down economic policy actually worked.
Hmm. Well, you've given us a lot to think about. I really appreciate you taking the time to share insights and wisdom, and I hope we can continue the conversation down the road.
Sounds good. Thank you.